Hello, everyone, and welcome to the Money by Chris podcast. Let me rephrase that. Welcome, everyone, to the first episode of the Money by Chris podcast. I'm your host, Chris, and this is, you heard it, episode one of the Money by Chris podcast. So I talk to a lot of influencers that say, Chris, the first time that you do anything, you're going to suck at it. These are business coaches. These are friends and mentors who are would be considered successful out in the world. And many of them say the same thing. You might have seen something similar on social media that says the first time you start anything, you're going to suck at it. And I am a financial planner specializing in positioning money for maximum use in retirement, guaranteed lifetime income, tax-free retirement income, those types of things. And I think I'm pretty good at it because I've been doing it for a while. But this podcast, this is episode one. And although I've done presentations before and I've done webinars before, it is different. This is a podcast, and I've never done one. This is episode one. So according to the laws of the universe, the laws of the podcast universe, this episode's probably going to suck. So, all that to say, if you're watching at home or listening in your car, be easy on me in the comments as far as execution. What is this podcast about? So, obviously, from the title, Money by Chris, we're here talking about money. Uh, but what about money? So, my day job, if you will, is helping people over 40 position their money for retirement. Usually, when we're saving money for retirement, we want it to do something in retirement. Everyone's a little bit different. Everyone wants their money to do something different in retirement. And that's what I do. I help determine what is it you want to do, and then we position your money to do that thing that you want to do in retirement. And it all involves, for most of my clients, it involves, okay, what do I do today for my plan? And then what do I do tomorrow? And then what do I do when it comes time to retire? And we talk about a wide variety of strategies. What this podcast is designed to do is share some of those strategies with you at no cost. I do have a legal disclaimer that says this is not a financial advice or tax advice, but what you can see here is guidance and some options of what you've got available to you when it comes to retirement. We'll be discussing subjects all the way from taxation to guaranteed income to life insurance to investments, all kinds of different means by which someone can manage their money today if you're in retirement today, or today if you're going to be in retirement next year or next decade, whenever that's going to be, you're going to get some insight on what people just like you are doing with their money to position for success down the road. The series that we're going to start here with episode one is tax-free retirement series. The tax-free retirement series is what we're going to start with. And there's usually a line, there's a rift when it comes to tax-free planning and retirement. Most people don't like paying taxes because paying taxes is a drag. But there's usually a line, there's a divide. Some people say, I hate paying taxes. I want to do anything I can to avoid it. Other people say, I don't mind paying taxes. It's just part of the whole gamut. It's part of life. We can't avoid it. Understood. What I'm talking about here is what can we do to minimize our taxes in retirement? Because if we lower a tax bill, we increase our income. For example, if you're withdrawing $1,000 of money from your 401k, let's say, and let's say you're paying a 20% tax, let's just say by example, or 22%, you would be giving $220 of that 1,000 to Uncle Sam. You would keep the other 780. Whereas if you did not have a tax bill and you withdrew $1,000 and there was no tax due, you get to keep all $1,000 in your pocket. So essentially, avoiding a tax obligation is almost like getting a pay raise because you're putting more money in your pocket for every instance, for every withdrawal. So because of that, tax-free retirement is something that we can talk about, and it's worthy to talk about it now. In this series for tax-free retirement, we will be discussing a handful of different things, one of which is the subject today. And that's going to be the 401k versus Roth 401k. And the reason why I picked this one is because some of you listening at home don't even know you have an option for a Roth 401k. And I know this because before I got into this industry and I had a 401k, I did not know a Roth was an option either. So we're going to discuss a 401k versus a Roth 401k. And this comes from people of all ages. I've had adult children of clients ask, what is the difference between a 401k and a Roth 401k, and which one should I choose? And I've had that instance happen in my own house. So we're going to talk about that. Speaking of my own house, I do want to share that when we discuss things on this podcast, it's usually because I have lived some portion of what we're discussing. These are instances that I have with myself and my own family. And a lot of people, they don't know that a Roth 401k exists. That includes my son. And my son, who is 19 years old, he's about to turn 20, and he is going to school at a local community college to get his degree for accounting. Recently was hired at a big box retailer. And this big box retailer offers him, even though he is considered part-time and even though he is considered an hourly wage employee, they offer him access to the 401k plan. This 401k plan includes a company match up to 5%, dollar for dollar, up to 5%. So he says he's excited. He's such a nerd, just like me. He says, Dad, I get access to the 401k plan. All I got to do is wait 90 days, and then boom, I'm in the 401k, and I can start putting money in the 401k. And I say, great, that's awesome. We're going to do it. We're going to save so much money. You're going to be like a millionaire. Awesome. So then I say, all right, so let's wait the 90 days. Let's get to that point where they make you the offer. Then we'll start looking at options. He says, okay, 90 days passes. He gets the offer to start contributing to his 401k. At that point, we get together, we start saying, okay, we're going to set up your 401k. He's like, yeah, I'm ready. And then I say, before we get started, I want you to put up your right hand, raise your right hand, and you're going to make a solemn swear to me today. He says, okay, I'm going to put up my right hand. And I say, I, Candon, his son, his name, Candon, my son, I will never, ever, 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 ever contribute money to a 401k. And it was a little taken back a little bit because he thought, wait a minute, I thought that's what we're doing. We're setting up my 401k so that I can contribute to it and watch my money grow. But he played along. He said, I will never, ever, ever contribute money to a 401k. I will, and we continued, I will only contribute money to a Roth 401k. He says, I'll only contribute money to a Roth 401k. So we said that, we did it, we got him set up. What I told him was, son, I do not contribute. So I work at an employer where I have a 401k. I told him I will never, I do not ever, and will never forevermore contribute money to a regular 401k. I will only contribute to a Roth 401k. And I told him, you're going to do the same. Since if you're a client, I would give you the option, but since you're not, since you're my son, I'm telling you, only contribute money to a Roth 401k. He says, okay. I said, I promise you, it might not make sense or you might not understand what's happening right now, but I promise you in about 40 years, you will greatly appreciate the fact that all of your retirement savings is in a Roth account versus a deferred account, which is a traditional 401k. So you might ask, okay, Chris, why do you only contribute to a Roth 401k? And why do you insist that your son only contribute to a Roth 401k and not a traditional 401k? Well, I'm going to tell you right now. So a traditional 401k is a taxed deferred account. What that means is you put money into the account from your paycheck, let's say. Your employer will not tax that money. Let's say you're putting $200 this pay period into your 401k. Your employer does not tax that $200. that $200 sits off to the side untaxed. It hasn't been taxed yet. And let's say you had a $1,000 paycheck, you put $200 into the 401k, now you have 800. You're only being taxed on the 800 that you're taking home with you. The money you put in the 401k is not taxed and will not be taxed until you take it out of the 401k down the road when you are age eligible to do that. Here in the United States, that age eligibility is 59 and a half. So once you reach age 59 and one half, you are now eligible to take money out of that 401k without paying a penalty. And at that time is when you'll be taxed on whatever it is you take out and put in your pocket. That's what we call a tax deferred account. So when we talk about tax deferment, we talk about putting money in a 401k or an IRA. A 401k is issued by your employer typically. IRA is something that you have by yourself. If you don't have an employer, or if you're self-employed or 1099 type employee and you want to save for retirement, you can do so in a Roth. I'm sorry, in an IRA, individual retirement account. Usually, when you leave an employer and you want to take your 401k with you, typically you're rolling that into an individual retirement account. Your 401ks are issued by your employers. What many people don't know is that that employer that's offering you the 401k also offers a Roth version of that 401k. You can pick. You can pick between, okay, do I put money in my 401k or do I put money in my Roth 401k from this employer? What's the difference? And we're going to talk about those differences today and about why I insist on putting money in the Roth version and why I told my son he must put money in the Roth version as well. When you put money in the Roth 401k, you're being taxed on it today. So instead of, in that example, instead of having like if you have $1,000 paycheck, you're putting $200 into a 401k, you're only taxed on the 800 that's left. When you put money in the Roth 401k, you're being taxed on the whole 1,000. So you pay tax on everything, including the 200 that you're putting in the Roth. Then it gets put into the Roth 401k. Now it's in your 401k, but in Roth status. Some people ask, okay, what about the company match? What happens there? With the company match, it will depend on your 401k plan, but many plans these days will allow you to have your contributions put towards the Roth account as well. Some 401k plan administrators insist that the match dollars go into a traditional 401k because it's not taxed yet. If that's the case, that's okay because it's company match. It's free money, may as well accept it. But some employers will allow you to put the company match in the Roth 401k with your contribution. In that instance, you'll be taxed on that match as well. So in that case, you're paying tax on your contribution and the match that you're receiving all at one time in that paycheck, and then all that money goes into the Roth. The advantage to having a Roth 401k is that down the road in retirement, the money in the Roth is not taxable because you've already paid tax on it. The tax, when you made the contribution, you made that contribution after you already paid tax on those dollars. So there is no tax to pay when you're 60 or 65 or 70 when you go to pull money out of that Roth 401k. And that includes your company's match. So all the money, your contributions plus the money that your company puts in there for you is all tax free when you go to take it out down the road. So the big question comes up, what most people ask is, okay, what's better? Do I pay tax on the money now, or do I pay tax on the money later? What some financial experts will say is, well, the idea is later you're going to have a lower tax bracket than you do today. So it's better to defer paying tax on that till you're retired. And then when you're retired, you have a lower tax bracket. So it's better to pay income tax on those dollars later. So deferment is the right answer. I like to challenge that. Based on what I have been seeing with my clients and based on what I've been looking at in the tax code, that might not be accurate. The idea behind I'm going to have a lower tax bracket when I'm retired, it comes from one of two ideas. Idea number one is that taxes are going to be lower in the future. And here's the truth, we just don't know. We have no idea what taxes are going to be like in the future, even just 10 years. So if you're 55 and you're planning on retiring at 65, that's just 10 years down the road. Some people will argue, oh, taxes will be lower then. Some others will argue, oh, taxes will be higher then. And some others will argue, oh, they won't move at all. They'll stay the same. The truth is we don't know. We have no idea what the tax rate is going to be down the road when we retire, when we plan on taking this money out, whether it's 10 years, 5 years, 20 years, 30 years down the road, we just don't know what the tax rates are going to be. So argument number one is our rates are going to be lower when we get older. We don't know that. We just don't know. Here is one bonus secret. Bonus secret number one. Write this down if you can. The tax code is not based on your age. It's based on income. It's not based on your age. So if you're 60 years old and I'm 50 years old and my son's 20 years old, we all pay the same tax rate regardless of what age we are. It's all based on a tiered system based on income. So regardless of how old you are, you're going to pay the same tax rate as anybody that's a bunch of years older or a bunch of years younger than you if you pulled in the same dollar amount in the same state. So it's not based on age, it's based on income. So let's take a look at that. Option number two. Well, the reason why your tax rate is going to be lower when you're older in retirement is because your income's going to be lower. Okay, that could be an option, but most of my clients don't want their income to be lower in retirement. Some people have that idea. Some people say, well, when I'm older, when I'm in retirement, my house is paid off, my car is paid off. If I have any student loans, I don't, those are all paid off. I'm debt free or very close to being debt free. And my biggest expense at that time, which was raising my children, well, they're grown and out of the house and off making money now too. So I don't have as big of bills, which means I don't need as much income. That is true to a point, but most of the clients that I talk to don't necessarily feel that way. When I talk to people in their 50s and 60s today, I'm hearing people say, well, yeah, I don't have to pay for my house anymore, but I have to get ready for medical expenses. Or I'm already dealing with medical expenses that are quite expensive. For many people in retirement, their biggest expense, their home or raising kids, gets replaced with medical expenses, staying healthy, cost of prescription, cost of medical procedures. That replaces, you trade out one expensive uh, obligation for another. So for that purpose, many of my clients say, Chris, if I make $100,000 a year, I want to keep making $100,000 a year in retirement. Okay, well, let's take a look at the tax bracket. This is the current tax bracket. It says for 2025, but it's also the current tax bracket for 2026 as well. So let's take a look at what that bracket looks like. So here is that bracket. You can see right here, there is the tax rate on the left, there's the single filers on in the middle, and the married filing jointly filers on the right. This will determine what your tax rate is. Now, when you look at this tax rate, a lot of people feel like, let's say you are a single filer, just for ease of argument. Let's say you're a single filer making $100,000 per year. You would be in the single filer bracket between 48,000 and 103, that's 22%. A lot of people feel like, okay, I pay 22% on all my tax, on all my money. If I make 100,000, that's 22%. So that's going to be $22,000 of my 100,000. Not really, because your first 10% is between 0 and $11,000, 0 and 11,900. So you're paying the same tax rate as everybody else. Your first $12,000 is taxed at 10%. From there to 48 is taxed at 12. You're only paying 22% from $48,477 up to 103. So it's not 22% of your whole money, but it's a tiered system. So if you're making $100,000, you're up to the 22% tax bracket. Well, let's just say that you're looking at retirement and Social Security is going to pay you, let's say 40% of your working wages. So you've got a tax bill of 22% and you have $100,000 per year when you're working and you get $40,000 per year from Social Security when you retire. Most of my clients are saying, Chris, where's the other 60 coming from? Because I live a lifestyle that demands $100,000 and I want to keep it even after I retire. That $60,000 extra is coming from your 401k. If your money is in the 401k, that 60%, that $60,000, that gets taxed also. So if you've got $40,000 a year in Social Security that is being taxed, as taxable income, and you've got 60,000 coming from your 401k, that's taxable income. Well, you're still at the 22% tax bracket. Your taxes have not lowered at all because you're still exactly where you were, regardless of age, regardless of with assuming these tax rates don't change. If you're making $100,000 at age 30 or at age 60 or at age 70, your tax rate is still the same. So the argument of defer money and pay tax on it later when your tax bill is lower isn't accurate in today's economy. Most people want to keep their income level the same. And when I talk to clients about rolling their 401k into an income product that pays them guaranteed income for life, they say, is it taxable? I say, yes, it is, because it's coming out of your 401k, which is tax deferred. That means every dollar of that money is being taxed. But imagine for a minute if instead of putting that money into a 401k, imagine if you put it into a Roth 401k. And you're looking at the exact same situation. You're making $100,000 a year. You want to retire. Social Security is going to pay you 40,000. You want another 60,000 to stay at that $100,000 level, let's just say. Well, the $40,000 you're getting from Social Security is indeed taxed. But the 60,000 that you're pulling out of your Roth 401k is not. It's not taxable income. You've already paid tax on it. Those are the rules of the Roth 401k. The distributions that you take after age 59 and a half are tax-free. Actually, they're tax-free, period. But of course, if you take money before 59 and a half, you have to pay a penalty. But regardless, whether you pay a penalty or not, as long as you wait until your proper age, 59 and a half, you're taking that money out of your Roth 401k tax-free. There is no tax due. It's still income for you. It's just not taxable. So even though you're bringing in $100,000 a year, you're only turning in a tax bill of $40,000 because that's the only income that's taxable. So now not only are you a lower, heck, at $40,000, now your tax bill is only 12%. None of it reached over the $48,000 mark. So now you're only paying 12% on that tax. Yes, that's true. None of it went over 48,000. The part that did, the 60,000, you're not paying 22% on it. You're paying zero. You're paying zero on the dollars that came from your Roth 401k. So for that purpose, when I'm talking with people about 401k versus Roth 401k, I usually tell them that if you're contributing money toward your retirement, it's usually going to likely be in your financial best interest if you put that money into a after-tax savings vehicle such as a Roth 401k. Now, a lot of people will say, okay, well, if that's the case, why put money in the 401k at all if it's after tax anyway? Well, there's two reasons. Number one, you still want the company match. The whole purpose we're saying yes to a 401k anyway is the fact that our company is paying us a dollar for dollar match. So if you're getting 100% match up to 5% of your income, dollar for dollar up to 5%, of course you want to put 5% in. Putting it in a Roth will ensure that when you go to take that money out, that money is tax-free. So that leaves that big question for people. Is it better if I pay tax on these dollars now, or is it better if I wait and pay tax on these dollars later? Well, I've just given you a compelling reason to believe that maybe my tax rate will indeed not be lower in the future. Either we don't know, or there's a good reason why it might not be lower. But that's actually not the reason why Roth 401ks are so powerful. The reason why Roth 401ks are so powerful, write this down. Bonus secret number two. Definitely want to write this down if you can, or bookmark this so that you can write it down later if you're driving. The gains, the growth of the money that is in your 401k is all taxable, but the gains that are in your Roth 401k are not. If you put money in your 401k, of course you're contributing to it, but you also want it to grow. You want that money to grow on its own. In other words, if you left the employer and stopped contributing and stopped getting company match, you want that money to grow on its own with the market. Any money that is grown in your 401k is also taxable. It's growing at a tax deferred rate. So when you go to pull it out, all those gains are taxable. But if you did the same thing in a Roth 401k, the Roth money is not. You put money, contribute money into the Roth 401k and then leave the employer, don't contribute any more, don't get any more company match. That money is still likely growing with the stock market. Those gains, that grown money that's inside the Roth 401k, isn't taxable either. It's all tax free. So that makes the choice whether or not to contribute to a 401k or a Roth 401k, which is better. That fact makes the choice of what to do much easier on us as 401k owners. And it goes like this. Let's say you're putting money, let's say you have $1 million today in a 401k, let's say you've spent uh, 20 years, 30 years working for the same company, and today you've got $1 million in your 401k, let's say, and let's say you're 55 years old. So you're going to retire. Let's say your plan is age 65, which is 10 years from today. And let's say you didn't contribute another dollar to your $1 million 401k. You've got 401k, $1 million. You're 55, you're going to retire at 65. And at 65, you're going to turn on Medicare. And now you're going to take your 401k money and you're going to live on it. It's reasonable to believe it's reasonable to believe that that $1 million could grow maybe to 1.7 million by itself without any contributions over a 10-year stretch. Based on performance of the S&P over the last 10 years, it's reasonable to believe that that could occur again. And if it did, you would have $700,000 in growth. Let's just say, as an example, you have $1 million. 10 years later in that 401k, now it's at 1.7 million. If that were to happen, you would now have $700,000 in gains in that policy because it grew 700,000 over that 10-year stretch. That 700,000 is taxable. And if you withdraw it, let's say at the 22% tax rate, 22% of 700,000 is $154,000. So of those gains, that 700,000 in gains over that 10-year stretch, 154 of it, let's say, presuming it's all paid in the 22% tax rate, 154,000 would go to Uncle Sam. You would be left with whatever's left over, with the remainder. Or let's say that same exact $1 million was sitting in a Roth 401k and it grew 700,000 over a 10-year stretch, let's just say. So now you have $700,000 in growth in your Roth 401k. That $700,000 is not taxed at all, period. There's no tax due on it. So when you take the money out of that Roth 401k, let's say you were to take that 700,000 out, there's no tax due on it. You could take it all out at one time if you wanted to, and it would not matter because it's not taxable. It's an asset that has grown tax-free. So the dollars that you put into the Roth 401k, your contribution dollars, those are taxed. Your company, your employer match, if those go into the Roth, those are taxed too. But the growth inside of that account after your contributions have been made, those growth dollars are tax free, unlike a 401k where those growth dollars are taxed. So that makes the question easy. Do you want to pay tax on those gains or do you not? It's a very simple question. Let's say you had a million and it grew to 1.7 over 10 years. You would, at a 22% tax rate, owe $154,000 on those gains. It's $700,000 for the gains. Do you want to write a check, $154,000 to the government, or do you not? Would you rather keep that money in your pocket? Because if so, if you say, I don't, yes, I want to write the check to the government, I don't mind paying taxes, then nothing's wrong with your 401k. But if you say, no, I want that money to stay in my pocket so that I can use it in retirement, I'm going to need it. The only way to do that is by contributing your money to a Roth. The only legal way, I should say, the only legal way to build assets that are considered tax free is through contributing to a Roth account. Most people know what a Roth 401k or Roth IRA is. I'm talking about a Roth 401k. You can actually start this from the very beginning. So that's the question. Do you want to pay tax on the gains of your retirement growing on its own, or do you not? If you don't, then contributing that money into a Roth 401k may be your advantage. It is for that reason, that primary reason, why I contribute my dollars, my retirement dollars, into a Roth 401k. That's the big question that you would ask, and it makes it much simpler. It's a much more simple discussion. I expect this account to grow. When it does, do I want to pay tax on the growth or do I not want to pay tax on the growth? And that's one of the biggest, to me, glaring reasons why a Roth 401k has its advantage, but most financial advisors overlook it. And most of your plan administrators overlook it. They overlook the idea that, wait a minute, if I'm growing money over here in the Roth, all those gains are tax free versus growing over here in the 401k, which means all those gains, all that gained money, I'm eventually going to have to pay tax on when I take the money out and use it for my use. Now, that might lead to a couple of questions. Some questions that I get frequently when it comes to people who have been contributing money to a 401k. Question number one is, okay, I've been contributing to a 401k. I'm now believing, I'm still going to work for a while. I'm now believing that contributing money to a Roth might be the right answer for me. And based on this fact of, yeah, the gains that I'm growing are going to grow tax free, I want to do that. I've decided that I want to start contributing to a Roth 401k. Can I do that? And the answer is usually yes, you can. Every plan administrator, 401k plan administrator, is a little bit different. But for most of you, the ability to stop contributing to a 401k and to start contributing to a Roth 401k through your existing plan administrator is usually pretty easy. Typically, there's going to be a login. You're going to be able to log in to take a look at your 401k balance, and somewhere on there, it's going to talk about contributions. You have the ability to, if you wish, go into those contributions and make a change to, do I want to allocate to a pre-tax account, 401k, or do I want to contribute to a post-tax or after-tax account? That's the Roth 401k. You usually have the ability to do this any old time you want. You don't have to wait for open enrollment like you do for your medical benefits. You can do it anytime you wish. So, and reach out to your plan administrator, your 401k plan administrator, if you have any questions. But in general, that option is available to anybody with a 401k. So with my son, when we were setting up his 401k, I said, see right here, you see where it says you can contribute money to your pre-tax account, that's the 401k, and you can contribute money to your post-tax account, that's the Roth. We're going to choose the Roth. That's what we're doing. Another question that I get commonly is, okay, is this going to mess up my company match? Because again, I like getting that dollar for dollar match, 5%, 6%. I've even seen some companies pay dollar for dollar up to 10% of your income, which is fantastic. That's free money. Definitely want to take every single bit of that free money as you can. But some people ask, well, if I make this change, am I going to mess up my company match? And the answer is it's up to your administrators, but in general, the answer is no. In general, generally speaking, when you contribute money to your 401k, your employer doesn't care whether you're putting it in a 401k or a Roth 401k. They want you to get the company match regardless. And many times, as in with my son when we did it for his employer, it says it right there. We took a look at it. See where it says right there, eligible for company match, pre-tax, eligible for company match. Down here, post-tax or after-tax, eligible for company match. So it'll say right there in black and white on the forms when you're looking at it. And most of this is done online. It's done through your 401k administrator portal. So you can do it online, quick and easy. Probably do it during your lunch break if you want to do that. Do check with your plan administrator. It's usually something as simple as writing a quick email to HR saying, hey, I have a question on my 401k. Who's the best person to ask? They'll connect you with the right person and then ask them, I plan on changing my contributions from 401k to Roth 401k. How is my company match treated? And typically they'll give you the answer of yes, yes, you will continue to get company match. Yes, it is dollar for dollar up to the same percentage. The only difference is you'll be taxed differently. Okay, so now another question that comes up is, okay, where's my company match going to go? Let's say I'm contributing $10,000 a year to my 401k, and now I want to switch it so that I'm contributing $10,000 a year to my Roth 401k. I'm supposed to get 10,000 in company match. Where's that company 10 grand going to go? And that's a good question to ask your administrator. Typically, they're going to tell you that contributing to your Roth 401k, you're still going to get your company match. Some 401k administrators say that the company match still has to go into the traditional 401k. Well, if that's where it has to go, then okay, it's better than not having it. So if they say your company match must go into the 401k by default, okay, no big deal. You can always convert it later if you wish. There's no limit on conversions, so you can convert all that money later if you wish. We're going to talk about Roth conversions in a later episode of this podcast. So if that's your question, skip ahead a couple of episodes and you'll see I think we're titling it "To Convert or Not to Roth Convert." To Roth Convert or Not to Roth Convert. That is the question. So we'll talk about that in a later episode as far as conversions. But nonetheless, they might say that. They might also say, yes, we're going to put your company match in your Roth with your contributions. If that's the case, then of course you'll be taxed on all of it today. And now let's talk about some taxation. So one thing that must be looked at is, let's say you got $1,000 and you're contributing, let's say 5%. So 500 of or $50 of the thousand, let's say $1,000, uh, and you're contributing $50. You're getting a company match of $50, right? So if you're contributing $50 to an IRA or a 401k, it's pre-tax. You're being taxed on the remaining $950. That's the tax bill that you're paying for that pay period. So you're getting paid, let's say $1,000, putting $50 in, that's your 5%. You're getting 950 left. Company matches $50. So now you've got $100 in your 401k, 50 that you put in, 50 that your company put in dollar for dollar. So now you've got 100 and you've got 950. You're paying tax on the 950. If you are Roth converting that 50, or I'm sorry, if you're contributing that 50, your 5% to a Roth 401k, now you're paying tax on the whole thousand. So the amount that you're paying goes up a little bit. In other words, if you're normally contributing money to a 401k and now you start contributing that money to a Roth 401k, you're going to see your regular paycheck decrease by a little bit. The reason is because now you're paying taxes on a whole $1,000 because the money that's now going into your Roth 401k, you're being taxed on it today. So that means your paycheck is going to be treated as though you're paying tax on the whole thousand. And you'll notice that if you make that change, your take home pay is going to decrease a little bit. And the reason is because you're paying tax on the amount that's going into your Roth 401k, whereas you were not paying tax on the amount going toward your traditional 401k. So be aware of that. Your paycheck will decrease if you're on a fixed paycheck. If you could pay the same amount every single month, you're going to notice that your take home pay is a little bit lower because you paid taxes on that contribution. Further, if your company says we're going to put your company match in the Roth 401k as well, okay, if that's the case, they're usually taxing you on that contribution as well. So that means if your $1,000 is your paycheck and you're putting 50 in the Roth and your company's matching 50 and they're putting that 50 in the Roth, that means you're paying tax on that pay period for 1,050 because you're also paying the tax on the contribution that your company put in the Roth as well. So all that to say is that if you switch from putting money into a 401k versus putting money into a Roth 401k, you might notice your paycheck, your take-home paycheck decreased slightly because your tax bill just went up. You're paying more tax on the contributions that you were not paying before. That is true. Which is better for you? That's something that you are going to want to talk with your tax expert about, your CPA or your tax person. You're going to want to talk with them about that to find out which is right for you. If you want to talk with us, we can offer you some guidance, one-on-one guidance, depending on your situation. And there are some situations where keeping your tax bill low each year is ideal. Having said that, many people believe, and many of my clients believe, that if I have to pay tax on it anyway, if I have to pay tax on that money now or later, it doesn't matter. Uncle Sam's going to get their money regardless. Paying tax on it now keeps the bill modest, relatively modest. It keeps the bill under control, and most importantly, it sets me up for tax-free retirement down the road. So that is something to consider. You can consider one thing or you consider another. I had one client tell me, Chris, do you think I'm dumb if I want to keep contributing to my 401k and not start contributing to my Roth? I know what you said, that what you do, and I know what you told your son to do. I just want to keep things the way it is. I just want to keep contributing to my regular 401k and not put money in my Roth. And the answer is no, that's not dumb at all. You do what you feel is right for you. And because of what I just explained, because switching from putting money into a 401k to a Roth, it's likely going to make your paycheck decrease a little bit because your tax bill, you're paying the same tax just on more money than you were when you were tax deferring some money into a 401k. For that purpose, some people say, I just want to keep my paychecks the way it is. Understandable. And if that's what you feel is right for you, that's okay. I'm just explaining here what options are available and the benefits of those options. And I have seen people who have saved $1 million in their 401k talking about, I want a Roth convert and I want a Roth convert now because I don't want any more of my growth being taxable. Convert me now, all of it. Convert all million or 2 million or however much I've got, 300,000, however much I've got in my 401k. I want to convert it now so I don't pay any more tax on the growth. I've seen many clients say that. And when that happens, many times they'll say, I wish I would have contributed to a Roth 401k way back when I got started. Understood. And that's why I share this information. But for some people feel like it would be better for me if I keep my paycheck the way it is and I don't make any changes and I just Roth convert down the road if I even want to. And that's okay. You're not dumb or irresponsible or foolish or anything for choosing the 401k path. That's not what I'm saying at all. I'm here simply explaining all the differences between 401k and Roth 401k. I have many clients who say, Chris, I just want to contribute to my 401k. And to that, I say, that absolutely, that's okay because that's your choice. You're not being judged at all. And I would say kudos to choosing that 401k because it usually leads to company match, which is value. I do think people are foolish for not contributing to their 401k at all because they're passing up on company match. But how you do that, whether you save it deferred tax in a 401k or pay tax now and my gains are tax free in a Roth 401k, that's completely up to you. And that's what you feel is going to be right for you and for your family going forward. So do be aware that if you're contributing to a 401k now and you want to switch to make that same exact contribution but to a Roth, your regular paycheck, what you normally see, will likely decrease a little bit because now you're paying tax on more dollars for putting that money into your Roth 401k today versus putting that money into your 401k down the road. Some people will ask questions such as, okay, well, you mentioned something about Roth conversion. What does that do? In a future episode, I think it's either the next episode or the one after this, but in this tax-free series, we are going to talk about Roth conversion and all the rules involving Roth conversion. We do it all the time for our clients. All the time when we're talking with our clients, they're saying, okay, I'm ready to retire, or I'm going to retire in 5 years. I've got my 401k. I'm 60 years old. I'm going to work for another maybe 5 years. I want to position my money for maximum retirement usage. What do I do? And that's where Roth conversion usually comes up as an option to stop the growth or stop the taxation on your growth and eliminate taxes coming out of that account in the future. Many people choose to do that while they're still working because while they're still working, they can financially support such a decision. But it is a big one. So a lot of people are looking at that. And because of that, I feel like, okay, if many people are seeing that in the future, they're seeing the idea of, wait a minute, saving a dollar amount that could be 20%, 22%, 24%. If I can save that money, that's like getting a 20 to 24% raise in my retirement income, which is at a time when I need it. Yes, let's do that. What I'm sharing here with the Roth 401k is there's a way you can build up to that. And so what I told my son is, yeah, you're going to pay a little more tax today for your contributing to your Roth 401k, but I believe that down the road you will be blissfully happy with the fact that you've got a large retirement account in the form of a Roth 401k that is now considered tax-free. So some people have asked, okay, if I do that, let's say I start contributing to a Roth 401k today, and then 10 years later I leave the company for whatever reason. They lay me off, or I find a better job somewhere else and I leave and go somewhere else. And now I've got this old Roth 401k. What do I do with it? You transfer that, or roll that, or I should say, you roll that over into an IRA account, just like you do with a traditional 401k. If you've got a 401k and you're ready to roll that over into an IRA, that's what you do. You roll that into an IRA. If you have a Roth 401k and it's time for you to roll that over because you've left the company or you've turned 60, you roll that over into a Roth IRA. So it's the same thing. The tax qualification stays the same. So if you have a 401k or a Roth 401k and you leave your employer and it's time to roll that money over into a personal IRA account, maybe to avoid those fees, those 401k fees, you would just keep it like for like. So a 401k rolls into an IRA, Roth 401k rolls into a Roth IRA. Uh, yeah, the same. That it's the same. I've seen a question come up here. That is the same if you have usually a 403b or a retirement account from a like a TSP. That's usually going to be the same. So you don't always have Roth availability for, say, a TSP or for a 403b, but many times you do. So if you don't have access to a Roth 401k or to a Roth 403b, then we'll take a closer look at that and see what's available. Some employers do, some employers don't, but the vast majority of employers will give you access when you're contributing to your retirement accounts. They'll give you access to a Roth version of what is available. So to recap, contributing money to the 401k. Why do people do it? Because they want that company match. If the company's going to match you dollar for dollar up to a certain percent, it makes sense to want to save for your retirement and collect that company match. But all of the money, what you're doing with that 401k is all of the contributions, all of the company match, and all of the gains that account grows by itself. It's all taxable down the road when you go to take money out. For your Roth 401k, your contributions are taxed at normal rates today. Your company match, in some cases, if that money goes into the Roth with your contributions, that money is also, you're paying tax on that also at today's rates today. But the growth of that account is considered completely tax free. And when you go to withdraw that money in retirement or use it or spend that into guaranteed income, or you're using that to say you just want it to grow and live off the interest, all of those distributions are tax free. Whether you turn that into tax free income guaranteed for life, or you just want to stick it into an account and live off the interest, like stick it in the bank and live off the interest, all of that, whatever money you're taking out of that account is now considered tax free and does not go toward your tax bill. And that does matter. If you have $100,000 in income in retirement, but only 40,000 of it is taxed, that lowers everything. It lowers the taxation rate on your Social Security. It lowers the amount of premium that you would pay toward your Medicare when it comes time for Medicare. It affects other aspects of retirement, which is why so many people believe in it, and it's why we help clients Roth convert or set themselves up for tax-free income in retirement. A lot of people, when they hear the words tax free, sometimes they think about cash value life insurance. And we do talk about that a little bit. I don't do a whole lot of it because I don't believe in it very much. And it doesn't mean it's wrong for everybody. I'm just sharing my beliefs. I don't love it because usually, if a client is looking for, if someone is looking for something that an IUL can provide, more often than not, there's something else that can provide that thing better. Whether a client's looking for a death benefit, there's another product that can provide a death benefit that's better. Whether they're looking to build cash value, there's another product that they can use to build cash value, maybe better. If they're looking for tax-free retirement income, there's another product that can provide tax-free retirement income better. So for that purpose, I usually don't sell a bunch of indexed universal life insurance, although they do exist. And sometimes when I talk to clients, they say, "Hey, tax-free income. Well, what about this IUL stuff?" We'll talk about it a little bit. And for some clients, I have sold that to them before, but it's not a product that I preach a lot about, simply because I feel like regardless of what you're trying that to get that policy to do, there's usually something else that's a better financial gain. There's a way to meet that need at either a lower cost or with a higher benefit somewhere else. And so for your financial best interest, there's usually something different that works out best. So I think we've covered everything that we need to cover on the 401k versus Roth 401k installment of the tax-free retirement series. If you have questions, you can shoot questions to me at Chris at retrieverfinancial.com. I'm sorry, Chris at retrieverfinancial.com. That's my email address. You can shoot me a question. Next week, we're going to talk some more about tax-free retirement, and we'll send you emails. So if you're looking to get notifications of these webinars or these podcasts, that's what we're doing. Episode 1 podcast. I forgot already. The podcast. If you're looking to get notifications, you can select notifications and you can like and follow our YouTube channel. And for listen wherever you normally listen to podcasts, I think you press the heart or the thumbs up. Maybe if you're on Spotify or if you're on Apple Music. Again, it's my first episode. I don't know how to do this part of it. So, but they say I have to. They say be sure and tell people to like and subscribe. So that's me. I'm telling you to like and subscribe. I think I did it right. I don't know. Anyway, so if you're listening to this on Spotify or on Apple Music, or if you're watching this on YouTube, just like it or press the heart. And you should, I think you have to press the bell to get notifications when we have a new episode. But just to let you know, we'll be launching new episodes every single week. So each week there will be a new episode talking about a retirement, an aspect of positioning your money for retirement. We're currently talking about the tax-free retirement series, but we'll be talking about everything from, are you ruining your kids for letting them live with you until they're 25? I know, I live it. What does it look like when you're getting married to your second or third spouse and they already have kids and you have kids? I know that, I've lived it. So there are lots of caring for aging parents. What does that look like? What does long-term care insurance look like? We're going to cover all that stuff in this webinar series. It's designed specifically for people and families who are looking to position their money properly for their best financial interest down the road. Legal disclaimer, we are not giving tax advice on this webinar or on this podcast series. We're also not giving financial advice. For specific individual financial advice or tax advice, you'll need to seek a financial or tax expert professional to be able to have a consultation with you and give you that advice one-on-one. What we are doing here is we're explaining aspects of retirement planning that is available to you. So we're just giving you some ideas on what's available, and then you can go back to your financial expert, your money guy or your money lady, and talk with them about, here's what I've got, here's what I heard. Hey, I heard about this. I heard about Roth 401k. What do you think? And that way, you're aware. You're aware of what the option is. You're aware of what's possible, and now you can take that, talk to an advisor, and make an informed choice. If you don't have an advisor and you want to talk to us at Retriever Financial, you certainly can. There's some contact information below. Shoot me an email, Chris at retrieverfinancial.com, and we can either assist you with some guidance or point you in the right direction to what you feel is going to be right for you. So I think we're just about up here. We're coming up on the 57th minute of episode one of the Money by Chris podcast. I hope it didn't suck that bad because, again, the experts say when you start something brand new, you're going to suck at it at first. I don't know. Let me know. Let me know what your thoughts are. Shoot me an email, maybe in the comments below. I don't even know if we're turning on comments. I guess they'll tell me. I guess the guys in the production room will tell me if we're turning on comments or not. Maybe if we are, let me know in the comments section if you think this is silly or if you think I left a bunch of stuff out. But uh, hang on, take a little sip there. The This is just, think of this as a couple of guys or a couple of families talking back and forth about money and about what options there are, what options are available. So we hope you liked it. I had fun. I enjoyed myself, so this is good. And tune in next week. We'll have episode two. We'll get incrementally better with every episode. So if you're looking for a better episode than this one, tune in next week for our next episode. And I'm not sure if that's going to be the Roth conversion or not to Roth convert, but it might be. So if it is, great. And any questions that you have, also with sending me an email, Chris at retrieverfinancial.com, retriever like the dog. If you have any questions, feel free to shoot an email to me and say, hey, Chris, I'm curious about this. Is this something you can talk about on the podcast? Answer is probably yes, as long as we get clearance to be able to discuss it. But yeah, either way, we'll get you your answer. But if you're interested in hearing something specific on the podcast, we would love to hear your ideas because this podcast is for you. It's intended to provide information to you guys, ideas, details, and possibilities for you guys to go and share with your financial professionals, tax professionals, CPA type folk, and maybe put together some new options for you in retirement, maybe an adjusted plan that fits your needs better. Thanks so much, guys, for tuning in to episode one of the Money by Chris podcast. We will see you next time, next week, same channel. Look out for the notification that we have a new episode that has landed, and we'll talk to you soon. Have a great day, guys.